This is Intelligent Investing presented by Fidelity Investments. One of the things we keep hearing from analysts and economists is this synchronized economic growth all over the world. This growth has supported global stocks over the past 2 years. And according to a recent note from Fidelity, all the world's major economies are in expansion right now, though some of them are in later stages like the US. Traditionally, emerging market stocks have benefited from the US's late cycle phase, which generally means inflationary pressures and rising commodity prices. Because historically, commodity-linked companies made up 20 to 30% of the emerging market index. But over the past 5 years, tech companies have become increasingly important in emerging markets, particularly in China. Tech stocks now make up 28% of the emerging markets index, twice as much as commodity-linked companies in the energy and materials sectors. So don't necessarily expect emerging markets to benefit as much as they have in the past when the US has moved into the late phase of its expansion. But Fidelity says it's still constructive on developed and emerging market stocks relative to the US. Valuations are a good indicator of long-term returns. And in that sense, international equity valuations look much more promising than the US. This chart shows valuations measured by the ratio of price to peak earnings over the past 5 years. US valuations are at the high end compared to other countries and compared to the average for developed markets and the overall measure for emerging markets, which is even lower. So while international stocks beat US stocks in 2017 for the first time in 5 years, you may not have entirely missed out. It seems there is a good case to be made for international stocks going forward. But keep in mind that emerging market equities are different than they used to be. And of course, expect more volatility everywhere as global inflation risk rises.